Hello, thank you for joining today's live session with James. I'm Ho-chan, Head of Global Communications in CryptoQuant, and we'll have James from Bloomberg as our guest speaker for today's podcast. We'll have Key, I'm not sure if he's here yet, but Key, CEO of CryptoQuant, Julio, Macro On-Chain Senior Analyst, and Barak, Regulatory and On-Chain Senior Researcher of CryptoQuant's Market Research Team with us. And we'll have Barak as the host of the live session today.
Thank you, Chan. I would like to introduce James quickly. James is a research analyst at Bloomberg Intelligence, specializing in the coverage of ETFs, mutual funds, and hedge funds. As far as I know, he's been working at Bloomberg Intelligence a little more than 8 years. Is that right, James, right? Yeah.
Yeah, so I've been at Bloomberg Intelligence since 2017, but I've been working at Bloomberg in total for 8 years. So half and half, roughly.
Awesome. So he also works with Bloomberg commodity strategies in the research of cryptocurrencies, since Bitcoin ETFs has become one of the hot topics in the last 2 years, and especially after the approval of Bitcoin futures ETF in October 2021. James' expertise has become extremely valuable for the crypto industry. Not only James, but also his colleague, Eric Balchunas, has provided very valuable insights to the crypto industry about the prospects of Bitcoin spot ETF and also the ETFs in other countries. We will talk about the trajectory of Bitcoin spot ETF applications in the United States. But before diving into the ETF space, we would like to talk about macroeconomic environment globally and how they related to crypto assets. For this, let me ask Julio, our senior analyst, to guide the conversation. And after that, I'm going to take over and talk about the ETF, specifically in Grayscale and ProShares short Bitcoin strategy ETF, which is going to be launched today, I believe. And in general, the spot ETF trajectory in the States this year and the next year. Have I missed anything, James, about the introduction? All good?
No, perfect. Sounds good to me.
All right, Julio, you can take over now, and then we'll continue after that. Thank you.
Thank you, Barak. Thank you, James, for being with us today. For the macro section, I would like to ask you your opinion about 4 narratives that are out there in the market. One is the Fed monetary policy. The other is Bitcoin and the stock market height correlation in prices. Third one, Bitcoin as an inflation hedge. And finally, the crypto contagion risks that are out there today in the market. So if you, let's start with the Fed monetary policy. If you could give us your opinion. In terms of US monetary policy, the cycle has changed from quantitative easing to quantitative tightening and higher interest rates as inflation has been persistently high and above market expectations. Do you think the Fed will keep tightening monetary conditions going forward? What will be the implications for this for Bitcoin and crypto markets?
Yeah, so I mean, this will kind of answer. I'll try not to answer too much in one shot, but this will touch on the inflation narrative too, or the inflation hedge narrative. I mean, my view and the view of most of the people I work with at Bloomberg Intelligence is that Bitcoin is a risk asset. There's a lot of maybe you can the argument it's almost like a call option, a store value asset, or it could eventually be an inflation hedge at some point in the future, but it hasn't been adopted by enough people in our view to truly be those things. I do own Bitcoin, full disclosure, but I don't really necessarily agree with that narrative. So when you go back to what the Fed is doing, the Fed, you mentioned their hiking rates were in quantitative tightening. When you have risk assets, which include things like equities, Bitcoin, quantitative easing, lowering interest rates, pumping money into the economy, adding liquidity, I mean, that is going to send prices higher. And undoubtedly, that was the environment that we were in for a number of years for Bitcoin. Part of the reason Bitcoin went to new all-time highs. It was just a very positive macroeconomic backdrop for Bitcoin because it is a risk asset. So now we're in the exact opposite situation. We just had a 75 basis point hike. We're in for another 75 basis point hike. I think then it's like 50 and then 25 and 25, if I remember correctly. So we're heading for a lot of rate hikes in the near future. And I mean, I'm not a macroeconomist and I won't pretend to be a rate strategist. We do have people on our team that are rate strategists, but their view is they're not going to slow down rates until inflation starts slowing down. They think there's potential that they can get rates and slow down inflation by raising rates without sending the U.S. economy into a recession. That's, who knows if that's even possible. That they refer to that as a soft landing. They're expecting to increase unemployment numbers in the U.S. It's just going to create for we're in for a bad economic situation. And the question is basically, how bad is it going to be? And again, going back to crypto, if they keep hyping rates, they keep raising rates, they're taking liquidity out of the system. Bitcoin thrives on a lot of liquidity. It's a positive thing for Bitcoin. So right now there's a negative backdrop. So if we just look at the macro landscape, it doesn't look great for Bitcoin. And obviously we've seen that in the price, it went below 20,000 this weekend. So I'll just stop there before I keep rambling on. But that's our view of the situation, how crypto and Bitcoin are impacted by the macro landscape.
Thank you. And actually, that was going to be my next question was, what would it take for the Fed to reverse or pause this tightening policy? You said about, seeing lower inflation numbers, or maybe if the economy slows down more severely. So
I would say it's definitely exactly that. The inflation needs to come down and slow down. But part of the problem is interest rates control isn't like, that's not going to control oil prices, which is hurting the US, it's hurting global consumers anywhere, and food prices. I mean, so they look at core CPI, which excludes food and oil, which is honestly what's impacting things the most. So the Fed interest rates can only do so much. They can do a lot. One of the other big issues is home price inflation. That's undoubtedly going to be impacted with what's going on with the interest rates. But the Fed's not going to stop until they see inflation come down, I don't think, or something breaks. I mean, if with raising rates this quickly and this much, if something goes wrong in the financial system or something really starts to go haywire, maybe they pause. Who knows? But the consensus from the Fed is basically they're going to hike rates and they're going to start cutting rates again, I think in 2023 or 2024, to bring things down. They just basically want to hike rates, get inflation under control, and then slowly ease off, take their foot off the brake, essentially, to stop they don't want to strangle the economy. But like I said, the best thing they can do is they want to enact a soft landing, which means they can get inflation under control and not send the economy into a recession.
Okay, so but for this year, we shouldn't expect the Fed to pause or reverse. They're really concentrated on getting the numbers of inflation down, right?
Yes, yeah, they're not going to stop. I mean, the inflation numbers printing as high as they were, the last inflation print last month, or I guess it was this month, was even higher than economists were expecting. So I personally don't see them stopping their current trend without those things happening. Okay.
Thank you, James. Let's move to the second narrative, Bitcoin to stock market correlation. We've seen price correlation between Bitcoin and the stock markets rise to record high levels in the past few months, meaning that their performance has moved in tandem, when in the past it wasn't the case. What do you think it means for Bitcoin in particular and crypto assets in general? Does the narrative about Bitcoin being an alternative uncorrelated investment to the stock market still valid? And what do you think traditional investors feel about this?
So I do think it's largely an uncorrelated asset. I mean, the further back you go, the less correlated it gets. So it's basically becoming more correlated with the global financial system, which you could argue, I mean, you could probably make both arguments. This is not what was outlined in the white paper, or it is what was outlined in the white paper, becoming part of the global financial system. I mean, there's two ways to look at it. One reason is I mentioned Bitcoin and crypto. We'll just stick with Bitcoin for this conversation. I view it as a risk asset, and risk assets tend to move together. So undoubtedly, there's going to be increased correlation as this becomes part of a more regular part of the global financial system. I mean, it's talked about in every financial news network. They're talking about the Bitcoin price. They're looking at it. Everyone's kind of talking about it. You can't write research now without at least mentioning what's going on with crypto, because there's been so much money, so many people interested in it. So that's one aspect of why the correlations are likely rising. The other aspect is there's a lot of similarities between the investors that were in these growth stocks, these names that were up hundreds of percent in the equity market, that are also, so a lot of these names are down over 90% that people talked about, like the Zooms, like what we're on now, Peloton, a lot of these other things that were hyper growth potentials during lockdowns and during coronavirus. And they had a lot of the similar investors that Bitcoin does. So when you have a very similar investor base between two types of assets, you're going to get similar returns, because when they get margin calls or they have to sell or do X, Y, or Z, it's going to affect everything they hold for the most part. So those are two reasons why I think that correlations have gone up. But also, it's not like they're one for one, as many people would make it seem. They are different assets, but it's way more correlated than it has been historically. So I wouldn't say it's one to one, but the correlations are increasing. And I don't necessarily know that that's completely a terrible thing, but it's obviously something that I'm watching. And Mike McGlone, who's our crypto, he writes about the macro landscape for crypto, and so he's watching that as well. But it remains to be seen exactly what's going to happen going forward. Obviously, we're in a new paradigm with the Fed raising rates.
Yeah. Do you think like it's a matter of the time span that we see, like and maybe in the long term, Bitcoin is not that correlated, and the narrative could hold in the longer term. Another is like it's just about right now. It's just about macro and the Fed tightening and everything just it's moving at the same pace and the same time. So it's more related to what the Fed is doing. Maybe is that what do you think?
Well, recently, yes, but I mean, we saw correlations going up before the Fed started tightening, especially with things like QQQ, the high tech, high growth names, which again, I think is because of those similar investors. They were buying the same stuff. They had a lot of money, and that's where they were putting their money. But I also think the narrative could break down eventually over time. But in hard times when all risk assets are going down, correlations are going to increase. Yeah. It happens every time there's a crash. Correlations head closer to 1 when things go down. And you basically, what's that Warren Buffett quote? When the tide goes out, you see who is wearing pants. And we're obviously seeing that right now more blatantly than anywhere in the crypto space. There's a lot of people that were over levered. There was a lot of people saying beforehand that people are over levered in this space. And when the tide goes out, we're going to see who is wearing pants, and we're probably it's not going to end. I don't think it's over. We're likely to see more names that go under because they were over levered or overexposed to projects that are essentially going belly up.
Okay, thank you, James. Yeah.
Can I ask a follow-up question, James? There's some argument about Bitcoin decoupling, and it's like there's two arguments, but I like to hear your opinion about the first one. Is that if Bitcoin decouples from the traditional markets, the necessary condition environment that should be that the inflation should be under control. As long as the inflation is a fear, the Bitcoin is actually will be highly correlated with the traditional like stock markets, traditional finance. Do you also think that same way? Like the argument basically this: Bitcoin will and eventually and hopefully will be less correlated. But in order to see that, first and foremost, we have to see the inflation under control so that the macroeconomic environment storm has to be abated to a certain level. Do you agree with that? Just the necessary condition, not the cause and causal relationship.
I kind of hinted at this before. The way I view Bitcoin is one of the ways, like everyone views it differently, right? So if you want to say gold is a store of value, it's like, Bitcoin is a store of value and Bitcoin is digital gold, which gold is a store of value. I kind of view it almost like a call option. So a call option, like it has unlimited upside, limited a certain amount of downside. If you look at, I wish I could pull up a chart of the way a call option looks, but essentially that's the way I kind of view Bitcoin. It has the potential to do the things that you're talking about, but it's not an inflation hedge right now. The one thing Bitcoin has been historically, especially for people in Turkey and Venezuela and other countries, it is a hedge against currency debasement. I mean, with the losses we've seen in the Bitcoin market now, maybe not as much as in the past, but it's still better than losing 90% of your value in 2 years with inflation in other countries. So I view Bitcoin basically, so if we take a step back and look at what gold has done, gold is roughly flat this year. Inflation is up a significant amount. Obviously, we keep talking about high inflation, but if you look at gold, it was up decently in the beginning of the year. We saw gold ETFs and gold funds that store physical gold taking in a bunch of money. We saw prices go up, but now it's basically flat. Like gold is up less than 1% so far year to date. And I actually just wrote a note about gold, and we often write, like, people say gold is an inflation hedge, gold is this, gold is that, gold is an equity hedge. Gold is not any of those things, right? The only thing gold really is a hedge against is the US dollar. And one of the reasons that gold is not up so much this year is because the dollar has been very strong on the world stage. So if you look at it, gold in times of inflation, gold over the long term tends to keep up with inflation, right? But over the short term, that's not necessarily always going to be the case. It has a near zero correlation. Like equity's up, sometimes gold is up with it. Equity's up, sometimes gold is down. I mean, sometimes it does nothing like it's doing right now. Equities are getting crushed and gold is at 0%. So we look at gold as a good portfolio diversifier. And that's the way I typically tend to look at Bitcoin. But again, it's more of a risk asset than gold is, despite what a lot of Bitcoin maxis and people will argue with me that it's going to be. The fact of the matter is it's just not there yet. So like I'm not somebody that says you should have all of your money in Bitcoin. It makes sense historically to have had a 5% allocation, 1% allocation to the crypto market in a broad diversified portfolio, depending on how you look at it. But again, it comes back to the fact that gold, again, is not a inflation hedge. So if Bitcoin is digital gold, it's going to do that. Bitcoin might not necessarily be an inflation hedge, especially over the shorter term. But again, if you look at gold prices over this year to date, if you look at gold in British pounds, if you look at gold in the euro, you look at gold in the yen, all these big currencies, it is way closer to all-time highs. Some of them are at all-time highs right now if you price in different currency. And that's because the US dollar has been so strong, largely because the Fed is raising rates in a few other areas because everyone around the world is having issues with inflation. So basically, it might, if Bitcoin is going to be digital gold, it will be more of a hedge against currency debasement. And to take a step, currency debasement just means like losing the value of your currency. So yeah, I'll stop there without, I don't want to keep rambling.
Thank you. Thank you.
Thank you, James. Yes, and I was actually gonna, the third point is inflation hedge, Bitcoin as inflation hedge, but you already touched on a lot of those points. But just one question: do you think that for investors they have realized that, or have they think now about Bitcoin as not being an inflation hedge? Or what do you think is investors? How do you think they see this?
So I think, like I said, over the long term, there's the possibility that Bitcoin will be adopted as a true store value asset like gold. And like I said, over the long term, gold, over hundreds of years, gold has basically kept up with inflation. People will say, like, you could buy a suit with the same amount of gold that you could buy a suit with today, essentially, a really nice suit. That's the whole store value. But it's not like something that happens like, oh, inflation has ticked up 1% this year, and then Bitcoin or gold is going to go up 1%. It's just more of over a long term. So even if you argue that Bitcoin is going to do those things, it's not a hedge in my mind is something that's going to completely offset it. And maybe it'll eventually offset it over time. But like I said, I view Bitcoin as a risk asset at this point. And maybe the fact that obviously 21 million coins only, all these things, we know exactly how much are going to be created. But again, that's also going to create volatility and price swings, which we obviously have seen for the history of Bitcoin. And I'm not sure, a lot of people say the volatility is going to go down, and it is slowly going down, but it's picked up a lot, obviously, in the last few months. So it has the potential to do all those things that I'm talking about gold doing, but it's just not there yet. And it remains to be seen if it will ever be adopted. But like the one bull case there is that young people seem to think of Bitcoin as a store value asset. They're more comfortable with digital assets than the older generation. So it might take a long time before that gets adopted. But that's just consensus opinion, I think, by most people. As younger people get older and have more money, it might be more beneficial for crypto assets.
Yeah, so it's also a matter of adoption, right? To see that, and it's not like a instantaneous process. It's a long-term process as Bitcoin gets more adopted, and we maybe see that those kinds of properties, right?
Yes, exactly.
Okay, so let's move to the crypto macro conditions. You know, we talk about macro conditions in general, but the crypto industry has also its own macro conditions and also its own risks. So we have seen in the last few months important events in the crypto industry, like the collapse of Terra and Luna, liquidity issues at some services or companies like Celsius or Three Arrows Capitals. Could you first explain to our audience, you know, how these type of services work? You can choose anyone you would like to explain, and why are they facing this kind of troubles?
So I don't want to pretend to be like a crypto market expert. Like I love talking about the macro, and I know certain cryptos better than others. But if you just look at like what's happening with Three Arrows Capital, Three Arrows Capital is, I mean, I would call it a hedge fund for simplistic purpose. They're just involved in a lot of different things in the crypto space. They use money to invest in different areas. They try to get asymmetric returns, to get upside returns, but they were obviously over levered. They put a ton of money into the Terra Luna situation. So Terra Luna was the first domino to collapse, really. I mean, I don't know if I'm the one that should be best explaining what Terra Luna is happening, but essentially Terra was a algorithmic stablecoin, which we have yet to see one that actually works out. I've seen for over a year now, basically that a lot of people have been saying it's not going to work. It works until all of a sudden it doesn't, and that's what happened with Terra Luna. And basically the way it worked was, as long as Luna has value, which now it doesn't, but as long as Luna had value, you could exchange $1 worth of Luna for 1 Terra, which automatically kept Terra in line with a peg between at $1, no matter what the price of Luna was. But as long as Luna had value, Terra was worth $1. And all it took was basically for that situation to collapse, people to lose faith in Luna and Terra, for that whole thing to collapse. There was a lot of money lost. There was a lot of people that were over levered into that ecosystem and lost a lot of money. And when you lose that much money, especially for big players, they have to start taking money out of elsewhere. So it comes back to contagion. So we saw some of that happen with Celsius. There's a lot of other rumors that other similar companies are having issues, like Babel. I saw recently Frank Chaparro of The Block talk about BlockFi having some issues raising capital. So there's a lot of things happen. There's a ton of rumors. It's hard to know exactly what's true. Honestly, well, some of it we'll probably never know it's true. It'll stay behind closed doors. You'll just hear from people that this might be happening, or you'll hear stuff on Twitter. So I mean, it comes back to that whole contagion, and it's just destabilizing things. So I mean, and then it comes back to what I was mentioning about before, Warren Buffett's quote, like when the tide recedes, we'll see who is wearing pants, right? And we're seeing that a lot of people really weren't. And I mean, it comes back to the way I view it. A lot of these staking protocols and this stuff, like some of it is very cool, but it's like almost like financial engineering to make more money, and not so much of it is actually being created to actually build useful protocols, in my view. But that's obviously, that's just my personal view. But I do feel like there's a lot of people trying to game the system, earn these 100% returns, bring people into the whatever. And I don't think that's the way that it should be done. Obviously, other people disagree. Obviously, CryptoQuant disagreed, offering those insane yields. So basically, one of the ways that they were doing that is Terra and Luna were basically bringing money into the ecosystem by offering insane yields that obviously were not possible. And so a lot of people lost their money because they put their life savings into things. I mean, I don't know. I've written and I've said on podcasts and I've said in interviews for a long time, like, people need to realize that, like, just because people say these things are relatively safe and you're lending stable coins and earning 9%, 20% returns, like, obviously there is no free lunch in finance and anything. Like, you are taking on significant risks. Even if you don't understand the risks you're taking, you are taking on risks. You're not getting, I don't know, 10% over the risk-free rate for nothing. There are some instances where that can happen, but people really need to do due diligence. And if you just look on Reddit threads and all these things, you can see people just really had no idea what they were talking about. And it's not just retail investors that didn't know. I mean, look at all the people with institutional capital, really smart people that got basically run over by what happened with Terra Luna and what's happening right now. You got 3 Hours Capital. You had Mike Novogratz lose a ton of money. You had a lot of people lose a lot of money in what happened with Luna and Terra.
Yeah. So for the retail investor, what would you say is a signal in this kind of soft projects that just is shouting risk? Do you think like the yield, like if you look at a yield like as you say 100% per year, so that's just not, it's not possible, it's not real. So
I mean you're basically hoping that you basically in those that's what I would say is the number one thing. I'm not a crypto expert. I'm actually in a coding class learning to do Python, so I'm as basic as it comes in some of this tech. I talk to plenty of people I do trust who are way smarter than me on that side of things. But yeah, I mean, if you're going into something and earning 100% yield, I mean, you're basically, everyone uses this term, but it's a Ponzi scheme. You're hoping to get that yield and get out before something blows up, essentially, right? You're hoping to get in and then sell at a higher price, or get in and get those returns and get your money out before things implode. So obviously, I'm sure there's plenty of people who are able to do that. It's mostly insiders, though. That's the problem. It's the insiders that are able to benefit from this, most likely. So part of the problem with the crypto market, why there's such a bad view of people outside, is this stuff where there's a lot of fraud. There's a lot of scams happening in the crypto market. And it's making the people doing the right stuff, doing very cool things, trying to build things for the future, look bad. And I just wish some of the people in the crypto community would be a little more critical of some of these side projects that obviously aren't really adding things. There's a lot of like cheerleading from people, and especially big names, obviously not the Bitcoin maxi crowd, but plenty of other people that are cheering stuff on that is like, I look at it and I'm like, I don't understand why you're cheering this on. But here we are. I don't want to throw names out there. Yeah.
Okay. Now, thank you, James. I think we should move to the ETF section, as I know there's a lot of interest on that. So I'll thank you, James, for the comments on the macro section, and get back to Burak. Thank you.
Thank you, Julio. I want to add something, James, about the BlockFi. This morning, they announced that they actually got credit from FTX, $250 million. And Zach Prince just announced it, like how, I mean, while I was like preparing for this 15 minutes ago, I think. And it's like everyone was like talking about this contagion risk, and BlockFi and other central DeFi platforms like, have risk, but they denied. And when we said it, just like you said, you don't know anything, like, they are good, they're perfect. But all of a sudden he announced that like $200 million credit from FTX, and said also bolster our balance sheet. So there was obviously something iffy there. So they had to get that credit to support their balance sheet. So that actually proves your point,
Yeah. So I saw like there was a tweet from guys at BlockFi. There was a tweet from people at Genesis. Like they say, normally we wouldn't say this, but we had a large creditor or a large client that didn't meet our margin calls, which I've heard rumors that it might have been Babel was one of them. I know for a fact at least one of them had to be 3 Hours Capital. I feel like everyone was talking about 3 Hours Capital going silent on them, who they were doing business with, even some people that were very close partners with them. So I mean, it's all like, it's obviously happening. People are obviously worried, and they should be, because if things blow up, it's going to send contagion through the system. And then if that happens, it's going to wash people out. There's always this talk about we need to wash out the levered longs and stuff like this. This is like that, but on steroids, because it's really wiping out some of the big institutional players, not just retail traders trying to swing trade with 100x leverage on these crazy platforms.
Yeah. All right. So let's move to the ETF section, and I would like to ask the questions to you in three categories. The first one is the most hot one, is the grayscale, because it's going to be soon. We're going to hear about it. And the second one is about the short Bitcoin ETF we heard today. I mean, not heard today, but it's going to launch today, I believe, or is already did. And the second one is like generally spot ETF approval. What are your thoughts about that? Because I'm going to mention some of your and Eric's analysis in the past. So grayscale, so I'm going to ask a couple of questions first, one by one, just to understand some like technical terms, and then ask more general questions. So grayscale Bitcoin Trust discount touch minus 33% over the weekend, and it became the big news everywhere. So despite new all-time highs in Bitcoin price since February 2021, the Grayscale premium has not been positive since then. So can you explain, like, technically why GBTC has been trading at discount since February 2021, despite the fact that we saw like all-time highs in Bitcoin price? Just to clear that, like, people know that why there's a discount there, and in what market conditions does GBTC premium or discount occur in general? And then I'll go like more general questions.
Okay, so I could I'll try to shorten this up because I probably need like 45 minutes to really explain this, but maybe not. I'll do the best I can. So Grayscale was the first people, they wanted to launch an ETF. So the Winklevoss were the first ones to file for an ETF, but Grayscale went about trying to get an ETF launched as well back in like 2013, 2014. And they couldn't get it done, obviously. So they went about, and the GBTC was the first one created. It had a different ticker. I added it to the system as a hedge fund. That's how these things start. They start as private entities or private trusts. They're what's known as a grantor trust, which may be too much information, but to take a step back, GLD, which is the gold ETF, is also a grantor trust. So these ETFs have an underlying legal structure before they file as an ETF or before they become an ETF. Most ETFs are open-end funds, which is a legal entity underneath the ETF. Gold ETFs, silver ETFs, things that hold single assets typically are what's known as grantor trust. So Grayscale from the very beginning basically created these, trying to model it so they can eventually convert it to an ETF because they knew it wasn't going to happen. So essentially this thing starts as a private placement, which is a private entity that you can only subscribe to if you have a certain amount of money. So when it's like that, you need to be an accredited investor, qualified purchaser, which has requirements on your income or the amount of assets you have. Basically to protect retail investors from just going to any old hedge fund, right? So that's the way all these Grayscale trusts and the Bitwise trust and these other trusts start. They start as private entities. So you have to be basically a PE fund or a high net worth individual, a hedge fund, to be able to put money into these trusts. So it starts, they create the fund. Most of the way the money comes in is people actually give them Bitcoin, right? So if I come in and I give them Bitcoin, they get shares in GBTC, right? So if I'm Grayscale, you come to me with a certain amount of Bitcoin, you give it to me, I put it in, we'll say vault, we put it in the GBTC vault, and in return you get GBTC shares. Now, one of the reasons why we had such a big premium, which I can't tell you how many people I argued with on Twitter that this thing could eventually go to a discount, and I just got screamed at saying it was nothing but FUD for literally years, but unfortunately I was proven correct. But essentially what happens is there was a lockup period. So initially when you do that, right? So you give me your Bitcoin, you get the shares. For years, it was a 1-year lockup, right? So you can't do anything with those shares. You have ownership of them, but you can't sell them on the secondary market. So what happens is there's constantly being new shares created, but as those shares are created, you're increasing the supply of GBTC. So the way I think about price is supply and demand, right? So as supply goes up, it'll meet demand, but there's a 1-year lag on the supply being created, right? So, and the other aspect of this is there's no way to decrease supply. So supply has only one lever, or only one way. It can only go up in these trusts for the most part. So as people were going in, and then the premium kept going up. So what this was doing was bringing in PE funds, hedge funds that like, look at this 30% premium, look at this 100% premium at times. Let's buy Bitcoin in the open market, give it to Grayscale. And Grayscale was then using Genesis, who's like another part of the digital currency group under Barry Silbert, then people would hedge the Bitcoin exposure. So they were only doing this basically to get exposure to that premium. And then after a year, they'd sell the shares and unwind their short, and they'd earn that difference between the premium and what GBTC was actually worth. So if it was at a 70% premium when they were able to get out, all of a sudden they took off their short on Bitcoin, they sold their GBTC shares, and they earned 70% on that 1-year lockup. Excuse me. And then, so this other process happened where it's the same process that they lowered the lockup period to 6 months when they became what's known as an SEC reporting company. But again, what it comes back to at this point, what I need to point out is that there was demand for GBTC. It took in so much assets, which people didn't understand was solely because it had a premium. people didn't care. There were people who couldn't care less about crypto or Bitcoin that were piling into these trusts to take advantage of that premium because it was, I don't want to say merger arbitrage, but it was an arbitrage trade to try and get those special situation returns. There's a lot of funds out there that look for special situations where there's asymmetric return potential, and this was one of those. Eventually, GBTC starts trading OTC, over the counter. This happened while it was in the 1 year lockup period. So I skipped that part, but essentially after a certain period of time, they can go through the 144, right? This regulatory process to list their shares on over the counter exchange. So these shares trade over the counter. It's normally not that liquid, but GBTC is like one of the most traded OTC securities ever, as far as I'm aware. So basically, when you need to get those shares, you ask for them back after your lockup period, and then you can unload them on the OTC exchange. So again, the premium was being driven by people wanting to take advantage of that premium. And what was happening is basically these high net worth individuals, these PE funds, these hedge funds, are just ripping off retail investors because they were unloading those shares onto retail investors who didn't understand what they were doing and just buying things at 80% premium. But part of the problem is that like people just wanted exposure to Bitcoin in their IRAs, in their other deferred tax accounts. So in the US specifically, you have what's known as an IRA or 401k, but for the most part, it was IRAs, which is basically a way to get like tax advantaged accounts. And there was no real easy way, especially early in like 2015, 2017, 2018. There's a lot of different options now, but back then GBTC was the only way to get access. So you had retail investors who wanted access, buying from hedge funds that were selling to them at like 80% above the value of what the underlying Bitcoin was. So essentially the SEC was just letting this happen. One of the big reasons why we were arguing even in 2018, 2019, the SEC should approve this thing is because it's just high net worth individuals, the rich, taking advantage of people in the retail world. So that was a whole bad situation. So that's why GBTC had such a high premium. And that's why I thought they should allow it to convert to an ETF. Because again, I kind of mentioned before, you can only go one way and there's a lag. So you're creating shares and there's at least a 6-month lag. Sometime earlier in the time, it was a 1 year lag. So you can only create shares. So as demand goes up or goes down, you can't get rid of those shares. With an ETF, it allows for this thing. It's called creation redemption. And the easiest way to describe it is if you have two bars, right? You want to have supply and demand equal, because when supply and demand are equal in an arbitrary sense, your price is going to be equal to the value of the underlying holdings, right? So what the ETF does is allows for people to exchange their shares for the underlying, right? So if I can always exchange Bitcoin for shares of the ETF, it's never going to go out of step because there's somebody always going to be willing there to take in and take advantage of that arbitrage, right? They're always going to be able to go in and say, all right, well, if Bitcoin's worth 10% more than the ETF shares, I'll give you my Bitcoin and I'll take the ETF shares because they're equal to each other, right? They're always going to be equal to each other. So that's why an ETF is superior, because there's no delay. You can change supply to meet demand. Well, what happened in 2021, as you mentioned, we saw GBTC's premium collapse into a discount and just keep going, essentially. And that's because, one, we had a few things happen. Mainly, it was the Canadian ETFs were launched. So a lot of institutional investors were using GBTC because if you look at ETFs like Cathie Wood's ETFs and other ETFs and other funds, they are not allowed to buy Bitcoin directly under like the way things are currently handled. So one way around it is you can buy a security. GBTC is a security. So these funds are allowed to invest in securities. GBTC is a security. They can buy GBTC even though it's at a premium, but they can get exposure to Bitcoin that way. All of a sudden, these Canadian ETFs get launched, which is a lot closer to the US than the European ETFs, which are even earlier. But so I think, one, a bunch of money went from GBTC to those ETFs. And then also, as that premium started collapsing, you had a double whammy with the fact that, like, I don't need to stay in this trade of those people who went in there just for the premium. And all of a sudden they were like, I'm unwinding this trade before it gets worse. So it was like a double whammy of some people leaving to go out elsewhere for their Bitcoin exposure. And the people that were there, not even for the Bitcoin exposure, were trying to unwind out of that trade. So they were just selling their shares as well. So it just basically compounded until everything went down. And again, it goes back to the fact that GBTC is not an ETF. There is no redemption program that can operate right now. So there's no way to decrease that supply to meet the demand for GBTC shares. Part of the problem, GBTC charges 2% a year. It's very expensive. So there's a lot of other issues that go in there, but it comes down to the fact that you can't change the supply to meet the demand. And the demand for GBTC is way lower because people are just like, they're going to use they use Gemini, Coinbase, Binance, FTX, whatever it may be to get their exposure. If you really know Bitcoin, if you want to stay in the traditional financial rails or use an IRA, some people were using MicroStrategy, all these different ways to get exposure. I think if you're going to do it in that way, GBTC is probably the best structure. But obviously, I think it was a 35% discount on Friday. I tweeted out. So, I mean, that's scary. But the one thing I will say that often gets missed by people looking at GBTC is that if something's at a 33% discount, right, and it needs to get back to zero, it's not a 33% return. So if you think about it, if you have $100 investments at 33% discount, it's trading at $67. To go from $67 to $100 is roughly a 50% return. So the upside is more than the discount, which a lot of people missed. And actually 3 Hours Capital created a structured note to try and take advantage of people not understanding that, which we can dive into. But that's something also I would point out, because I constantly get people that don't understand that.
Thank you so much for this comprehensive answer, because like I really wanted to know personally in the background what's happening with GBTC, because it is also very related to their application for the conversion. So that's going to be my next question. But before that, I was one of those individuals, by the way, those institutions take advantage of the retail who discovered those OTC deals. Oh, I can actually buy GBTC on my Vanguard retirement account and get some exposure. But I didn't know anything back then. So I was one of those people. So my question, yeah. So my question is that, so let me wind back a little bit. So on May 11th, CoinDesk has a piece stating that Grayscale has a productive meeting with SEC on Bitcoin ETF conversion. And the decision is to be made on July 7th. It's coming. And also the Bitwise Bitcoin Trust decision deadline is July 1st. We heard over the couple of months that Grayscale has been openly threatening to take the SEC to court if it's rejected. And Hester Pierce, the commissioner at the SEC, recently published remarks on the regulatory agency's failure to allow spot Bitcoin ETFs in the United States. And she said that it's time for the commission to stop denying categorically spot crypto exchange traded funds. So basically, the implication in here is that categorically denying that it's really not even looking at the reasons, but basically denying it at all costs. So I was so since this is going to be issued again in the next couple of weeks, what is your opinion about this threat in both politically and in legal terms, and the SEC's position with the Grayscale application, which is going to be in a couple of weeks?
Yeah. So first thing I would say is we don't think it's going to be approved. We believe it is going to be denied, and we expect Grayscale to file what's known as an APA lawsuit, or Administrative Procedures Act lawsuit. I'm not sure how long that lawsuit would take to play out, unfortunately. Could be 18 months. I'm not sure. I had an analyst on my team who knows a little bit more about that. But essentially what the APA says, it's the Administrative Procedures Act, and I'll just dumb it down because I'm not an expert on it, but basically you have to treat like situations alike. Basically, the fact that they approved a Bitcoin futures ETF and did not approve a spot Bitcoin ETF is not treating like situations alike, because you're allowing for a derivative on a market to trade in an ETF wrapper, but not let the actual spot market trade an ETF wrapper, despite it being a much better scenario for pretty much everyone involved. There's roll costs in futures ETFs. There's other issues, and for the fact that it's just a derivative, you're not actually holding exposure to the underlying asset. That's our view. My view is that, which Hester Peirce said it in her letter in a nicer way, but the way I would put it is Gensler and the SEC are holding spot Bitcoin ETFs hostage until they can get their hands on control of the underlying exchanges in the crypto market. They basically want to get the right to regulate the underlying spot markets. And until they get some sort of leeway or coverage on that front, they are not going to allow a spot Bitcoin ETF in the US to be approved. Now, I will take a step back. Like, I've been pretty critical of the SEC We could talk into all the reasons why I think a spot Bitcoin ETF should be approved. Issuers have done a very good job. They used to have tons of reasons, right, why they won't approve it. And the issuers have basically hit away at like all of them over the last few years with their repeated filing. A lot of people on Twitter who don't pay attention are like, they're just wasting their time doing this. But if you read through the documents, they've hit away at like a bunch of these different things on why they shouldn't approve at it. So like one of them, if we take a step back, you mentioned the futures ETF being approved in fall of 2021, which we accurately called, which we stuck our neck out and actually disagreed with a lot of people. And all we did was read what Gary Gensler said. Gary Gensler basically gave a speech in early August that said, we're looking forward to applications from issuers of futures ETFs based under the 1940 Act. And then we were like, all right, they're going to approve these 40 Act ETF filings. And other issuers literally filed the next day for 40 Act Bitcoin Futures F. ProShares had the filing sent to the SEC the next day. Van Eck was like a day or two, like another day after that. So a lot of issuers saw that and started going down that route. But what that did, and the issuers kind of went at the SEC hard, was one of the things that Gensler leaned on, obviously, in that situation was we like the 40 Act because it offers more protections. There are a few things that the 40 Act does that is more restrictive to issuers in what they can and can't do in the fund. And they leaned on the 40 Act because basically GLD, remember I talked about that grantor trust thing a little bit ago, those ETFs are they only are under the 1933 and 1934 acts. So basically they have certain restrictions. 1940 Act is basically a higher level of requirements for these funds. All ETFs are required to satisfy the requirements from the 33 and 34, but 40 Act funds also have to follow the 40 Act fund rule. So Gensler was initially arguing one of the big things was we like the 40 Act protections, not the 33 Act, which is, in my opinion, a little ridiculous. I mean, GLD is a 33 Act fund. There's tons of 33 Act funds out there. And eventually that got whittled away with Türkçe, which just got approved this spring, was a 33 Act futures ETF. And the SEC was basically, I wrote about this, the title of my piece was the Türkçe filing has put the SEC between a rock and a hard place, because either they approve the futures ETF because they already approved a futures ETF and the 33 Act and 40 Act aren't different enough to really satisfy the idea that one is better than the other when we have tons of 33 Act ETFs, or they don't approve it, and then that's a blatant APA violation, essentially, and they're going back on their word of what they said, why they would approve it, the fact that the futures market is a regulated market. So the one thing they keep going back to, I was critiquing the SEC, every time they've said they want a surveillance sharing agreement with a market of significant size of the underlying spot Bitcoin markets when they approve a spot Bitcoin ETF. So basically they want a market that's regulated by the CFTC or the SEC, or they want these exchanges like FTX, Coinbase, Gemini, Binance, whoever it may be, to send surveillance sharing agreements with the exchange it's listing on. So New York Stock Exchange or NASDAQ, so that if a regulator comes in and wants to figure out what happened, they can see all trades that ever happened on those exchanges, which one is extremely expensive for those exchanges to send to other people. Like they don't really want to open their books. Obviously, there's a lot of shady stuff that happens in crypto. So depending on who you are, you might not want to do that. So the SEC has leaned heavily on this surveillance sharing agreement requirement or a regulated market of significant size, which they haven't truly defined. So once that happens, that's when a spot Bitcoin ETF gets approved. And no matter what anyone else says on Twitter, if we get to the fact where there's an underlying spot market of significant size that's regulated by the CFTC or the SEC, or there's serious surveillance sharing agreements, we will get a spot Bitcoin ETF approved.
Well, thank you so much, because my next question and all my notes was all about this 33 and 34 Act and what's the difference and take room to Bitcoin futures ETF. So you basically covered all of that already. And so I was going to ask this in a general, you already answered it partially, but you and Eric also published a report that suggests Bitcoin spot ETF approval could be in early summer 2023. That also, your analysis refers to the definition of an exchange and how it could fall under the SEC regulation. I was going to ask you, could you elaborate on this analysis, which you already did, but let me change the question just a little bit. Does that analysis still stands with the fact that the Loomis and Gillibrand bill introduced last week, and if that bill actually goes forward next year, which is going to be the earliest, next year, maybe first quarter of 2023, is going to it will be taken seriously in the Congress, I believe. And do you think your analysis for spot Bitcoin ETF approval is in line with the bill and what's discussed in this bill?
So, I mean, maybe it's best if you explain what the bill is. I know tangentially what it is, but you're probably more knowledgeable. And then I can dive into a little bit more.
Sure. I mean, I don't want to go into so much detail because I would like to ask some questions, get some questions too. But the bill is basically giving CFTC more power to control spot exchanges, and that you actually mentioned that Gary Gensler wants more control in the exchanges too. So there's actually some divergence there, giving some role to SEC as well. But for the spot exchange controls, like regulations, actually intended to be given the CFTC more. So that's why I actually wanted to ask this. If this bill goes forward like this divergence between SEC and CFTC on regulations on crypto industry assets, basically, is this in line with your trajectory for the spot ETF approval?
So the exchange definition thing. So I'll take a few steps back. One, the first thing I would say is part of the reason why we think it'll happen in 2023. If I had to put a date on it, I'd probably say the second half. I mean, we could see surprises where things happen that it happens quicker. One of those things is the bill that you're talking about, which I'll dive into as well. But if we look to the exchange rule, basically, the rule that we wrote about, it's Gary Gensler, in our view, basically just wants, first of all, he wants to be the Treasury Secretary of the United States. It's basically like an open secret. He's a political animal. He's a politician, essentially, and he wants to get a higher level position than just chairman of the SEC. And we think, and I think a lot of people agree, that Gary Gensler wants essentially to be able to say, I team the Wild West of crypto on his resume when he goes up. And one of the other things is he can't anger or aggravate the people like Elizabeth Warren and the other senators who are very anti-crypto. Some of it, they seem to be toning down their language of where they were a while ago, but there's a lot of people that were higher up in government, especially people during Trump's administration, that were very anti-Bitcoin and anti-crypto. So Gary Gensler is obviously trying to do two things. One, he doesn't want to anger people on either side too much, which I think he's failing at, because no matter what he does, he's going to anger one side. But he's basically trying to be a politician, and he wants to, like I said, get on his resume that he took care, he cleaned up the Wild West, essentially, of crypto. So going back to the exchange rule, basically what the SEC is doing, and this proposal was many years ago, and it's just now like it's in the works. It's going to expand the definition of an exchange. Honestly, the number one thing I think it could do is like DeFi protocols would automatic, like under this new definition, would likely be considered to be an exchange. The other aspect is the definition of an exchange doesn't really need to change for crypto exchanges to become what's known as exchanges or alternative ATSs. They're alternative trading systems, and that would also, they have to register with the SEC to do that, right? So no matter what you do, you have to register with the SEC. The main thing that would happen, even without changing the exchange rule, without broadening it, is if they start naming a bunch of these tokens and cryptos as securities, it's the SEC, all of a sudden, they already are exchanges. And Binance, FTX, anyone operating in the US, Coinbase, has to register as an exchange or an ATS. So that would be one way that could happen. But sorry, 1 second. So that would be one way it could happen. But obviously, we've seen with Ripple, it's not that easy just to call something a security. I mean, how long is the Ripple litigation going on? So it's my opinion that we likely need to see something come from Congress, like the Loomis-Gillibrand bill, that brings us into another area. So one, I'll just say, if some of these things start getting called securities, basically these exchanges are probably going to have to register with the SEC because they're trading securities as far as the federal government is concerned. And honestly, if you're an exchange, maybe you let these underlying crypto companies or tokens fight that argument. But basically, if the SEC is providing enough pressure on these exchanges to start doing this and saying these are securities and we're going to start litigation and lawsuit, like all of a sudden, if it becomes more expensive to fight that litigation, than just register as an exchange, which is the money. It's expensive to be an exchange and register as an alternative trading system and do all these things that are required by the federal regulators. Then all of a sudden, maybe more people will come on board and just become regulated. the thing with the Gillibrand bill goes back to the other piece that I wrote in May. And I titled it, the FTX's CFTC proposal could be backdoor to a spot Bitcoin ETF launch. So without going in too wonky into the way that things work, CFTC has a proposal in front of the, FTX has a proposal, too many acronyms. FTX has a proposal in front of the CFTC, which, to take a step back for people that don't know, the CFTC is the Commodities Futures Trading Commission, which basically is in charge of commodities and futures and all these different things. The SEC is in charge, is the Securities Exchange Commission, which is in charge of securities. So think stocks, bonds, things like that. And they're supposed to work in tandem. They often butt heads on a lot of things. They're particularly butting heads a lot over crypto at this point. But FTX's proposal to the CFTC would basically be real-time monitoring. Usually there's margin, the way there's margin trading with, I don't want to get too in the weeds here, but if you're using futures, you're using margin trading, there's leverage automatically involved. And FTX wants to change the way that works, right? So that you can post collateral and do things that will be real-time monitoring. It'll be more automated than the current system is done with the CME, which is where the Bitcoin futures are. FTX wants to have its own futures, its own futures exchange essentially in the US. And without getting too in the weeds, basically what happens is they want the CFTC to okay this and allow for another model than what's currently legally allowed. Now, the key thing here is that one thing that FTX wants to do is be able to offer anyone leverage in trading spot and futures markets, right, on their platform in the US. And there's this thing under the Commodities Exchange Act, which is another regulatory act, but it's this one section, 2C2D, retail commodity transactions is what it's called. And basically, if anyone is entered into or offered to, even if not entered with, a person that is not an eligible contract participant, which basically means retail, it qualifies as retail commodity transactions, or if they're offered or even entered on a leverage or margin basis, the counterparty or person acting in concert, blah, blah, blah. So basically all this language is saying is if you're offered, even if you don't take it, to be able to use leverage in a commodity transaction, which basically CFTC, even Gary Gensler's admitted Bitcoin is essentially a commodity, it's considered a retail commodity transaction. Retail commodity transactions fall strictly under the purview of the CFTC. So if this proposal from FTX gets approved by the CFTC, all of a sudden their spot markets are a CFTC regulated market, right? So then it satisfies those agreements. So that's one area that I think if this gets approved, that's another way we could potentially get an ETF. But again, it has to be a market of significant size. It's likely that initially FTX's spot market is not a market of significant size as far as the SEC is concerned. But if other exchanges start following this path as well, who knows? It's just another way. One of the reasons why we said to the second half of 2023 is there's all these different things that are coming together to potentially have spot Bitcoin ETFs approved at some point in 2023. So it's not just the exchange stuff. It's not just my CFTC proposal. It's not just the bill that you were talking about. And there's a few other things that are happening with these exchanges. Like I know for a fact Coinbase has like a subsidiary that's technically registered as an alternative trading system already. So there's like all these things that some of these crypto exchanges are already on board and ready to handle if they have to register as an exchange. It's basically like in case we have to, we're ready to do this. It wouldn't be an instantaneous thing, but it's not like it's going to take them 2 years to be ready because they don't want to have to shut down or do anything along those lines. So there's a lot of different areas where we could see some of these SEC concerns for spot Bitcoin ETF get appeased over the next year or two. I mean, I'm not saying it's definitively going to happen in 2023, but that's why we said second half or middle of the year in 2023.
Well, thank you so much, James, because I've been following you on Twitter everywhere, just you share some snippets of these analysis, and I always wanted to talk to you, get more details. That's also like another reason I wanted to meet you, just chat also, but also like talk about some details. But I'm glad you share all of them with us. And another thing I like to thank you for, sometimes when we host this kind of events, it's really hard to get answers from guests. But that was not the issue with you because you were so open and explaining more in detail. I really appreciate that. You made our jobs much easier in that aspect too. Julio, if you don't have any follow-up question, I believe, Ho-chan, I will ask you if you receive any questions, then we can direct those questions to James.
So James, I forwarded you 4 questions on Twitter messages, and
Yep.
also I'm going to open to public. So everyone who joined this video session, now I have changed the session to open session, so you can ask questions publicly here.
Yeah, it's one thing I want to add that I didn't say when we were talking about the CFTC proposal from FTX. I actually used in my note, SBF, like there was people talking about whether or not FTX will become a regulated market to approve a spot Bitcoin ETF. And SBF quote tweeted that and said, we're working on getting federally regulated spot crypto venue that could help support this with an exclamation mark. So it's not just me like saying that I think this is going to happen. I've also talked to Brett, who's one of the presidents at FTX US. So this is not just me like protracting like what I think could happen. These guys are also saying they're trying to do it. So I wanted to say that it's not just me hypothecating that maybe this will happen.
Thank you.
And then the first question, which Ho-Chin sent to me. So the possibility of a futures market as a potential tool for spot Bitcoin price manipulation, not going to happen, in my opinion. I mean, so like the main thing that the SEC is debating right now is they're saying a spot Bitcoin ETF can't be approved because they approved a futures ETF because they're saying the CME futures market for Bitcoin futures cannot be manipulated by the underlying spot market because they would need to trade on like all the exchanges. But the funny part is like the futures market, it's the CME futures market is priced off of something called the BRR, the Bitcoin reference rate. And that's based on 6 underlying spot exchanges, which the SEC is saying is subject to manipulation. So they want an issuer to prove that the market can't be manipulated. So they say the futures market can't be manipulated because they need to do too much to have it happen. I would argue the same thing would happen for a spot Bitcoin ETF, because all the spot Bitcoin ETFs that are being proposed, it's not like we're going to use the price from Binance or we're going to use the price from Gemini only. They're going to use the same type of process of using the aggregated volume to give you a reference rate essentially for the spot markets, which is basically what the futures market is anyway. But the SEC is saying that in a spot market, somebody could manipulate the underlying market and thus manipulate the spot Bitcoin ETF, which I guess maybe theoretically is possible. But for the most part, you're going to be exchanging Bitcoin, underlying Bitcoin, for the shares of the ETF in that transaction, or issuers that are going to be handling this. So I don't really like that argument. And obviously Hester Peirce is on my side with some of the stuff she's written. But unfortunately, we're in the minority as far as the SEC is concerned. And then the second question was, what's the possibility of premiums and discounts on NAVs and Bitcoin ETFs? I did touch upon this when we talked about GBTC. The reason GBTC has such big premiums and discounts is because there is no creation redemption mechanism, which an ETF has. You can always create or redeem shares to fall in line with the underlying market. In a GBTC, you can't do that. So no matter what happens in ETFs, we do see discounts and premiums show up. But if you look at what's happening in Canada, I mean, that thing trades as tight as can be. We're talking like less than 0.0% typically discounts, because there's always trading. You can always hedge out of your Bitcoin risk because Bitcoin's a 24-hour market. Now, the only time this would happen is if we see things in so high yield muni bonds to get really wonky, like where the market freezes up, then the ETF is still trading, and sometimes things don't fall in line. But the only time that happens is when the underlying market freezes up and there's no trading, or there's something crazy happening in the underlying market, which I guess theoretically is possible with the Bitcoin market versus an ETF, but relatively unlikely. And no matter what the situation is, even if there is a discount or premium, I don't think it would be as extreme as anything we've seen in GBTC. Like I said, we saw over 100% premium for extended periods of time in GBTC's early days, and it won't last as long. So it won't be as extreme, and it wouldn't last as long, because as soon as the market stabilizes, the ETF would basically come back in line. And the third question is, ETFs in crypto, will it support better trading in crypto market or support the further manipulation of crypto market? I would argue it would support better trading. Basically, I mean, so the ETF market in the US specifically is in the US equity markets are the most liquid markets in the world. Aside from US treasuries, there's nothing that trades more, essentially. So basically, you take all those market participants, these super sophisticated investors, some of them are already dabbling in the crypto space. I mean, we saw Citadel recently entered, we saw Virtu. These are big, high technology trading firms that are involved. And I mean, they're not going to get ripped off by these scams that people are running and this other stuff that's happening in the underlying crypto markets. And essentially, the more liquidity that comes into space, the more players, the more efficient the market's going to be. You're going to have super tight trading spreads. We didn't really touch on this, but like you look at Coinbase and Gemini and some of these trading fees that they charge, and then you don't even, and sometimes it's really hard to figure out what the spread is. So trading fees like commissions, like you pay $1 or $2 or whatever it may be. And then there's also spreads. So like the market makers are making the difference between the bid and the ask, and the spreads are wide on these exchanges. With an ETF, you get like 0.1%, 0.01% spreads on some of these markets. So these guys come in. Honestly, one of the only reasons we used the Bitcoin futures ETF, so I didn't touch too much on this, but futures have roll costs. So you invest in a future, it expires every month, right? So in a futures ETF, you have to sell the current month that's almost expiring and buy the next month. And futures market typically operate in what's known as contango. So basically the next month is a little higher than the current month. If the opposite happens, it's called backwardation. But essentially, if you're selling the current month that's about to expire and buying the next month that's a little bit higher, you're selling here, buying here. So you're selling low, buying high, you're losing money. So every time you roll, you're losing a little bit of money. So depending on how steep that curve is, it could be a lot, could be a little, but no matter what, you're basically losing money as long as the market's in contango. So that's an inefficient use. That's one of the reasons why we don't like the Bitcoin futures ETFs. But one thing that they are beneficial for is it's probably one of the most efficient ways to trade crypto, especially for a retail trader or somebody who doesn't have an institutional account at one of those crypto brokerages we were just talking about, because the spreads are super tight, the discounts are and premiums are super tight. So the Bitcoin futures ETF is going to be cheaper than trading actual spot market. So that's one area where we view it, and a spot ETF would be even better than the futures ETF. And that's it for those questions. There's a lot in the chat. Oh wait, here's one. So one is on the yen. I'm not smart enough on the yen to talk about that. Like the way I usually talk about the Bank of Japan is they are just buying assets left and right. I mean, if you look at the Bank of Japan and the ETF market, they are the largest holders of ETFs like in the world. Essentially, they own like the vast majority of the Japanese ETF market. Solely because of them, like this normally, like right now, the top 50 largest ETFs are US, or like top 30 or something like that, aside from one ETF, which was basically made for the Bank of Japan to buy their equities. So we look at the US Fed, they're buying markets. They bought some ETFs, but it was bond markets. They bought some bonds directly. They didn't touch the equity market. Maybe in the next QE cycle, which will be even worse, even theoretically a better macro drop if they end up buying equity ETFs or equity market stuff like the Bank of Japan is. But so we're watching that obviously very closely. But I don't know enough about the Bank of Japan and their strategies. I don't know if anyone's on here can elaborate on what they're asking, but I'm not really an expert on that. I wouldn't pretend to be. So next question is, a lot of people waiting for a spot ETF. Do you think approval for the spot ETF is the most powerful news for BTC market? How much impact do you expect crypto market? So this is actually something we didn't touch upon here. People I often hear from, especially from crypto maxis and Bitcoin maxis, we don't need an ETF. Like no one needs an ETF. But if you want to see the price increase, you probably would like to see an ETF. So if you look in the US advisors, the people that advise people's money, have, depending on your estimate, 25 trillion in assets under management, right? The vast majority of advisors who have been studied in survey after survey, from Bitwise, from BetaShares down in Australia, from European crypto firms, they want exposure to Bitcoin or crypto in some sense. But right now, there's no easy way for them to do it. They're just starting. Obviously, some ETFs just launched in Australia. But in the US, if you're an advisor, it's not super easy to get exposure to the crypto market. So basically, providing that exposure would be very good. So say they want to put 1% of their assets in there, even less than 1%, 5%, whatever it may be. Basically, it opens that pool of money, that $25 trillion, to buy Bitcoin or crypto as an allocation in their portfolio. I mean, these people, it's not like they're going to, like 25 trillion is going to pour into the ETF market, to the Bitcoin market. Almost certainly not. But even if, I don't know, 25% of that 25 trillion decides they want to put 1% of their money into crypto or Bitcoin, that's a huge pool of capital that people can get access to. And I mean, everyone here knows, like, you start buying Bitcoin, you get interested. All it takes is like to get interested and really dive in and start understanding it. You become more interested. You become infatuated with what's happening. You probably read the Bitcoin white paper. All these things. So getting people more on board with the crypto ecosystem, the ethos, and what people are trying to do, not just the scams and the yield farming and all the stuff that's happening out there, the stuff at the baser layer. So again, it would definitely be a positive outcome for Bitcoin price over the longer term, in my opinion, just because you get open to a pool of capital that's not currently available, really. So if I take a step back, you're an advisor, you're some guy that sits down in Florida, right? And you have a bunch of client accounts. You're not going to open an account for each client to get exposure on Coinbase or Gemini or whatever, because you're going to put 1% of their money in it, right? That's just not going to happen. You don't like the Bitcoin futures ETFs because of the potential roll costs. The GBTC is a 2% a year trading at a discount. There's a bunch of issues with it, though. I would argue eventually, if it does get approved, I talked about the potential upside there, but obviously Bitcoin's been crushed. But so like, it'd be much easier if you have this system and you put this product that from the crypto ecosystem onto what I call the traditional financial rails in the US. So like, you don't have to open a new account with a crypto company, or you don't have to do any of this. You can just use what you're used to using to buy ETFs or mutual funds to get exposure to spot Bitcoin. That's a way easier process to do for all of your clients, or whatever clients satisfy or want exposure. Because part of the reason clients, advisors do want exposure is because clients are asking them about Bitcoin. So all these advisors are forced to learn about crypto and Bitcoin and whatever it may be, because their clients are asking them about it and saying they want exposure. And also the other aspect of this is a lot of their clients are buying exposure on their own. So they have their Gemini account, they have their Coinbase account, and because their advisor can't get access to it. And what happens is, the way most of the advisor system works in the US is you pay on a percent of the assets that you manage, right? So there's a fee that you get charged. So if you can bring that under your umbrella where you charge money, all of a sudden, like, even if I don't believe in Bitcoin as an advisor, but I have 20 clients who have, I don't know, 10 grand each in Bitcoin, all of a sudden I'm bringing a couple $100,000 under my umbrella, and then I'm charging 1% or 0.5% per year, maybe even more, on that money. So you just want to do anything you can to bring that under your umbrella. So there's a lot of different ways that it would end up helping drive demand and potentially adoption, who knows? But that's why it's a positive thing, and why people who say it's like against the ethos of crypto, that I would push back and say, like, take a step back and look what approval of a spot Bitcoin ETF would actually do.
We'll take Daniel's question as the last, and then end the session here. Would that be okay with you, James?
Yes. So I wish I could give you more color on the process of the APA argument. I will say GBC, Grayscale just hired like some serious litigators, some people that are higher up in the government under Obama's administration, to basically, they're going to fight the SEC in court. Now, like, I honestly, you know what, I'll reach out and I'll do some research and I'll tweet out about this. Because obviously this is a key question. I actually got the question yesterday as well. So I'll tweet out about it after this. But the SEC, the GBTC, Grayscale, they're going to fight the SEC in court. Now, the one thing I would take a step back and say is, the reason is Grayscale that's going to do this is all the other issuers, for the most part, that are trying to do this aren't crypto-only firms, right? First of all, also Grayscale has a huge war chest because of how long they've been managing money in the crypto space. And even though crypto's down, whatever, 70% now, or however much it's been down, it's up way more over long term. So they've made a lot of money. So they make more money. They charge 2% of the GBTC fee. So they have a large war chest to fight the SEC if they have to. The other thing is, a lot of the traditional asset managers probably don't want to, like, it's generally not a good strategy to, I don't know, piss off your regulator and file a lawsuit against them. I mean, obviously the regulator then can't retaliate, but it's just, you don't want to create that. It's probably not the best look to, like, basically file a lawsuit against somebody who's in charge of you. But again, they've kind of lost, they have no more recourse to do this. And obviously, as if any of you are on Twitter, you see a lot of, or some of you, I'm sure, are holders of GBC, just really angry at the discount and what's happening. They're getting angry at Grayscale. The one thing I will say is, a lot of people like Barry Silbert and Grayscale don't care. Michael Sunderson doesn't care. Like, they really want to convert this to an ETF. They've said from the get-go in 2015, the ultimate goal is to convert this to an ETF. So this isn't some like alternative conspiracy theory of them like trying to keep your money locked up. They understand how pissed off their clients are. and they do want to convert it to an ETF. It's just way easier said than done. And if basically Gensler isn't budging, he's not budging on what he wants to do. And like I said, he wants to get control of the underlying market. And without getting control of the underlying market, he's not going to freely give it up. So that comes back to the fact that the CFTC might get control. And I think CFTC is the one that should control these underlying markets, or not control, but regulate them, in my opinion. And I don't know how Gensler feels about that. I feel like he probably wanted to be the one to get those under control. So this might be something that annoys him if the SEC doesn't get control of the underlying exchange markets. But it's something to watch and something that's very interesting. And like I said, I'll talk to some people that are way more knowledgeable than I am on that side and tweet out about the APA litigation process.
All right, thank you so much. Yeah.
Thank you for your time, James. I mean, all the contents that you have shared today was very illuminating and clear.
Thank you very much.
Thank
I'm
you,
happy.
Thank you,
I'm
James.
happy it was clear. I hope I didn't ramble on too much for you guys, but I try to get everything I can. And
No, you didn't. It was great. Thank you so much. We learned a lot, and you really shed light on so many issues that you share snippets. But now, like, you know, we all the details. Thank you so much again joining us. We appreciate your time.
thanks for having me.
Thank you.